already learned how to buy and sell money, either with orders or directly on the market. It's simplicity itself with ID System, our trading terminal.
Now, there's nothing left to do but to identify the optimum moments to buy or to sell. A mere trifle. This trifle has tantalized traders over the centuries, and a whole science has developed called technical analysis.
The Western School of Technical Analysis has its roots in 19th century America.
I describe technical analysis as a science. What do I mean by this? Well, one thing I mean is that it's governed by clear and rigid laws. We'll start by learning how to plot price charts using a computer, of course, and then we'll move on to draw other lines. What are they for?
Well, these lines help us determine what will happen to price in the future. They also give us an insight into how long price will remain above or below these lines. Today we're going to examine these lines and how to plot them correctly.
The simplest price chart is the tick chart. What exactly is a tick chart?
Each new change in price is charted by a standard move across the chart. The chart takes no account of time, so the more times that price changes in, say, a minute, the more moves are made across the chart. This means that from 2 to 5 p.m. GMT, when the Frankfurt, London and New York exchanges are all open, there can be up to 10 changes in price in 1 minute.
And late in the evening, at 10 o'clock in New York, when the world's main exchanges are closed, there'll be far, far fewer price changes. So price is strangely warped and distorted on tick charts.
The tick charts on ID System, as well as those on other trade terminals, do not distort time. Each change in price is charted at the time it takes place. What we have here is a line chart, but one that charts price over a very limited period of time.
What are tick charts for?
Such charts are good reference points and are featured on the trading terminal to instantly inform our traders of any price change on the markets, but they are not used in technical analysis. So what kind of charts are used in technical analysis?
If you look it up in the dictionary, the word bar is a thin piece of metal, and we build our charts with bars. We'll show you how to plot a price chart now.
You already know that forex is a round-the-clock market, not forgetting the days off. And we've already mentioned that the trading day by international consensus comes to an end at 21:30 GMT. In reality, however, professional traders view the trading session as finishing at 2100. Why's this? Bear with us and you'll see for yourself.
With a bar chart, all the information about exchange price for any one day is shown on a vertical line.
Let's look at the monitor, a heartbeat after the chiming of Big Ben, marking the beginning of the day, and we'll see the first key price that's recorded on our bar. This is the open price, and it's marked as a little nodule on the left of our unformed bar. Punctually at the end of the day, an instant before the clock strikes, we look at the monitor again and we see a second currency price. This price is the close price and is marked as a second nodule on the right of the bar. The ceiling that price reached this day is known as the high price and is the third key price. There are no highs without lows, of course, and the price floor or low price on the day is also recorded. We join the high and the low points with a vertical line, and there you have it, the bar. a pretty widespread charting method. The four prices on the bar are referred to as O, C, H and L on the chart.
And day after day, or hour after hour, bar after bar is laid out, marking time with a standard step to the right, creating a reliable price chart. They've been monitoring and studying exchange price behaviour on the Japanese archipelago for centuries.
Rice prices have been recorded since as far back as the Middle Ages. If we want to draw a bar like the Japanese, we make the distance between close and open into a white rectangle, and the high and low prices are joined to it with vertical lines.
This new figure is called the Japanese candlestick, known to some traders as the candle. The rectangle is called the body, and the vertical lines are the shadows.
The candlestick body can change colour. If close is higher than open, as in our case, the body is white and it's rising. If close is lower than open, the candlestick body is black and it's falling.
Many traders find the candlestick more visually appealing and easier to interpret.
Take a look at the candlestick chart. With an uptrend, the chart brightens, and with a downtrend, the chart on the contrary darkens. When price is in a range, it flashes before our very eyes. We'll return to trends later.
History has provided us with a fascinating case study. Two independent groups of traders analysed the same phenomenon over a long period of time. They did not exchange any information, and yet they came to the same conclusions.
In Japan, where the candlestick was invented, a strict isolationist policy was in force until 1862, and this is why Japanese traders could know nothing about the American bar.
Because of these restrictions, and because of geography, candlesticks and bars were created completely independently of each other.
Although they were developed at different ends of the world, both bars and candlesticks use the same four main prices in their construction: open, close, high and low. This supports the thesis that exchange price behaviour is objective in character and submits to rigid laws.
Technical analysis is involved in the study and application of these laws.
The concept of trend is crucial to the technical approach to market analysis. Every tool that the trader uses, whether it's support and resistance levels, chart patterns, moving averages, trend lines, whatever, are applied in order to achieve one super task. The trader, that's you, uses them to identify and monitor a trend to allow them to do further work in its channel.
Let me digress a little here. I said work rather than play. When you play the market, it's very easy to lose money, though it's not impossible to win. But when you're working on the market, the only possibility is to earn money.
You'll often come across advice like, never trade against the trend, or the trend is your friend. So we'd better define a trend.
Generally speaking, the trend is the direction the market is moving in, but in my opinion, this definition is an overgeneralization.
In real life, no market moves in a straight line. A market moves in zigzags which resemble waves. Price rises and falls.
It's the directional dynamics of these maximums and minimums which determine trend.
The dynamics of these peaks and troughs, whether they're ascending, descending or horizontal, tells us about the character of the trend. If each subsequent peak and trough is above the previous one, we have ourselves an uptrend. It follows that if each subsequent peak and trough is lower than the preceding one, we've got a downtrend on our hands. If the peaks and troughs are at the same level, this is a range. Always remember that price can move in 3 directions: up, down and sideways.
Many beginners make the elementary mistake of thinking the market can only move up or down.
And it might surprise them to learn that, even according to the most conservative estimates, for about 1/3 of all trading time, price is neither rising nor falling generally.
This kind of price movement is known as a trading range.
This sideways movement, caused by similar up and down fluctuations, reflects a period when price is in balance, when the parity between supply and demand for a given good is practically constant. Charles Dow, one of the earliest pioneers of technical analysis, called this movement a line. Trading on the exchange is a piece of cake. Any trader has just 3 options: to buy, to take a long position; to sell, to take a short position; or, in general, to do nothing, to wait, to sit on the fence. If the market is trending up, it's time to buy. If it's down, sell. But if the market is flat, the best course usually is to do nothing.
But how can we learn when to do what? The answer's simple. Get into technical analysis. The majority of its laws and findings are the result of the blood, sweat and tears of numerous traders. These lessons were learnt the hard way. And remember, the wise man learns from the mistakes of others. The fool learns from his own, if he learns at all.
And that's straight from the horse's mouth. As well as being able to move in 3 directions, the trend can be one of 3 degrees. These are the primary or major trend, the secondary or intermediate trend, and the minor trend. These terms relate to the temporal nature of the trend and were introduced by Charles Dow. He defined the major trend as existing on the market for more than a year. These long-term price movements are shaped by fundamental factors. Let's take oil as an example. Consumption is growing each year. Reserves are limited. The situation in the Middle East as the main oil supplier continues to grow more unstable, and alternative sources of energy are still inadequately developed. The result of all this is that the price of oil has grown steadily over the last few years, and we can see this on the line chart. Dow defined the intermediate trend as lasting from 3 weeks to 3 months. Minor trends last no more than 2 to 3 weeks at the very most. Each trend type is made up of lower degree trends. In a major uptrend, the market can pause at any moment to react against or correct the trending movement for about a couple of months, and then move on to renew its ascent again. This intermediate correction, in turn, will be made up of a series of shorter rises and falls, and this repeats again and again. On the one hand, the trend is part of a larger trend, but on the other hand, it also includes component elements in itself.
you need to have a complete appreciation of the difference between these three kinds or temporal degrees of trend.
If someone asks you what the actual trend of the euro against the dollar is, before answering them you have to ask him what timescale he's thinking about.
Misunderstandings arise because different traders are working with and concentrating on different degrees of trend depending on their trading style.
For the position trader who keeps positions open over a long period of time, the price movement over a few days and sometimes even for a few weeks is of little importance. He trusts in the future and sometimes has good reason to. For the day trader who opens and closes his position within one day and works with a timescale of an hour or less, 2 or 3 days is already a substantial length of time, and a price movement over this period will represent the main trend for him.
This is why an insight into the different degrees of trend is absolutely vital. It's this insight that enables you to determine the direction of the current price movement. And as I said before, this is your primary task. We've spent rather a lot of time discussing the theory of trend in general and the direction of trend in particular. I'm sure that many of you are thinking that it would be very useful if the representation of the current situation could include a backlog of past information. Let me tell you, you're not the first to reflect on this.
Bars and Japanese candlesticks are not the only types of charts available to the trader. No less than 130 years ago, Japanese traders developed the sublimely simple Renko chart type. Renko filters out the noise and chaos of the marketplace, leaving a clear chart of significant market movements. This particular chart type is available, amongst others, with a few clicks of the mouse on our charting software Rumus.
You'll find full information on Renko in another film. In the meantime, after noting this new spoke in a wheel of technical analysis, we'll move on. We've already repeated more than once that price moves in zigzags and that by plotting the progress of the maximums and minimums of these zigzags determines the trend. It's now time to start naming these peaks and troughs that help us map the trend.
A horizontal line drawn through the last price trough, the last local minimum, is known as a support level. Support is a level or area on the chart below the market where price has fallen to a level where enthusiasm for buying has become strong enough to counterbalance selling pressure. In a second scenario, a horizontal line drawn through the last price peak is known as the resistance level. Resistance is a level or area on the chart above the market, where enthusiasm for selling has become strong enough to withstand buying pressure.
The history of these terms is fascinating. There was a time when a speculator on the exchange could only make a profit on a rise in prices. His only option was to buy at a low price and sell at a higher price.
And it came to pass that the level which bolsters price, which prevents it from falling further, was given the name support, and the level which impedes price and prevents it from rising higher became known as resistance.
Nowadays, my friend, it's all a matter of perspective. For a long time we've been able to make money on a fall in the price of exchange commodities, but the names have remained unchanged.
There are of course periods of time when price neither rises above the resistance level nor falls below the support level. We say here that price is in a trading range, that the market is flat. It is this circumstance precisely that foremost technical analysts John Murphy and Jack Schwager advise doing nothing.
But what should we do if this trading range lasts a few years or even a decade? Maybe you think that this never happens. Then you're mistaken. Let me assure you that it certainly does.
The British pound was in a range between 1.4 and 1.72 for 11 years. Once, in 1998, there was an unsuccessful attempt to make a breakout on the resistance level. And once, in 2001, there was an unsuccessful attempt to break out through support. Ignoring short-term resistance and support level breakouts, the range width was 3,200 points. It may seem a lot,
but believe me, this is treading water for such a serious currency over such a long period of time.
if we'd had prior knowledge of this range, we could have become millionaires a few times over.
Please understand that a trading range can last any length of time. You can find them on any time scale.
A minute, an hour, a day, or a week. The point and figure chart is the perfect aid for identifying the precise levels of a flat market. The Euro chart that you see before you now is of a very ordinary type, bars or candles. Now here is the same data displayed in a point and figure chart. In this type of chart, the support and resistance levels are very easy to identify.
So you can see what lengths traders have gone to clarify the situation on the market in order to make more money. You'll find full information of this less common but very useful point and figure chart in a later film too.
But what forces form these support and resistance levels? Of course, the relationship between supply and demand plays the primary role.
But in exchange trading, the psychological state of the participants in the buying and selling process, and here I mean you, the traders, play a significant part too.
You set these support and resistance levels yourself. This leads to many interesting outcomes. For example, after there's been a breakout on a resistance level, the level very often transforms into a strong support level later on.
John Murphy created an entertaining psychological account of this wonderful transformation. Let me carefully talk you through it.
I want you to imagine all of the traders in the world and divide this happy band into three groups. Those who have bought goods, which in our case is currency, and we'll call this first group the bulls. Those who have sold goods, these are the bears. And the third group of traders is peacefully sitting on the fence. They've not opened a position, and for the meantime they are simply watching the market. At this moment, price is just below the resistance level.
By the way, where do you think the names bulls and bears came from? These terms came from the frenetic exchange pits of the American market. Have you ever been to a rodeo or a bullfight?
If so, you'll remember how the bulls toss their horns at those courageous runners and the matadors. It's a sudden movement from below upwards, and the traders who buy in anticipation of a similar upward thrust in price are called bulls too. The awesome grizzly bear is found in North America. They are renowned for having the most fearsome forelimbs in the world. Their mightiest strike is from above downwards. Traders who sell in the hope that price will fall into the abyss in the near future, as if a grizzly has given it the treatment, are called bears.
Alright, let's leave the zoo and get back to the market.
For the purpose of our illustration, we shall work like many beginner traders prefer, without a stop loss.
And what's the point of stop loss anyhow? We watch our position like a hawk, and if price moves against us, we close our position immediately.
Let's see how everything turns out. Remember, as I said, price was in the resistance area. Now, we were not kidding when we talked about the strength of levels. It's much more likely that a price will bounce off from a level than break through it.
But at this very moment, something happened. Fresh news hit the market, which boosted price up through the resistance level, where it remained from a few days to a few weeks. Let's review the mood of our three groups of traders.
The bulls are happy, they're very pleased with themselves, life is good, but they're still hungry for more profit. If price falls back into the old resistance area, I'll buy more, thinks the typical bull. The bears are despondent, close to stupor. The thought of their probable losses if they close their position at the current price, coupled with the negative effects of leverage, transforms the ferocious bear into a mongrel, howling in despair on a cold, rainy night.
Yes, the road to hell is truly paved with good intentions. The bears are thinking that if price dropped just a little bit, everything would be okay. Here's the resistance level. They saw price break through. They wanted to close their position, but they hesitated, hoping that the market would turn their way. It could have, but it didn't. If they were given another chance and price returned to the old level, they'd buy. There's no question of it. They've learnt their lesson. They'd close their position. So, the bears are also ready to buy at the old resistance level.
The fence sitters have been on the sidelines for too long. They were daydreaming. They woke up when price blasted up through resistance. Now the key roll of the broken level is clear to them too. They're ready to join the bulls, but only if price falls back into the old resistance area. So we've got another group of potential buyers.
Very frequently, fate gives all three groups their chance. Price very often drops down to the old resistance level as if to check its strength. But at this point, buy orders stream in from all three groups and price rapidly pushes up once more.
If price had broken out on the support level, the chart would be a mirror image, and the former support would turn into a resistance level, just like that.
So happy hunting, my friends. So now we've got a handle on support and resistance, we need to add more tools to our charting toolkit.
An uptrend is made of a flight of trading ranges upward, similar to bricks building a staircase. If we join the minimums of these ranges, we have a trend line, also known as a support line. This is the trend line of a bullish trend, an uptrend. If our short flight of stairs leads downwards, join the decreasing maximums of the ranges to form another trend line, the resistance line. This is the trend line of a bearish trend, a downtrend. And when support and resistance lines are horizontal, they are known as levels. And we have what we've already discussed, a trading range, a sideways trend.
So there's that word trend. It shouldn't confuse because
an uptrend is made of a series of rising local minimums and maximums. And a downtrend is a series of falling local minimums and maximums.
So now you know, that's an exact definition of trend. You may ask why I'm banging on about trend. What's the big deal?
Traders and analysts use the idea of trend in close association with trend line. Support and resistance lines provide us with precise measurable borders of the range of price, existing not only in the past but also in the future. Support and resistance levels give us future price ranges too. We need at least two local minimums, two troughs, to map a support line. Many traders will map this straight line only after there is a price breakout of a previous resistance level, and this is a reasonable strategy. Other traders plot the line earlier, when price passes halfway between points 2 and 3. Note that the formation of a fresh trend with precise borders can only be confirmed by a third testing of the support line, followed by a price rise from it. It's the same story for two local maximums to chart a resistance line. The trends gradient is easily measured by how many points price moved during the 5 minutes, the hour, the day, the week, depending on your chosen timescale. This is an important and absolutely objective measurement of the speed of the rise or fall in price.
Technical analysis was formerly and justly known as the art of charting.
When a trend line is being endorsed, the confirmation price sometimes does not reach the trend line, or, on the contrary, it crosses it. When this happens, it's advisable to plot a second trial line and let time be the judge. In this situation, we suggest carefully monitoring closing prices. They must be situated above the support line and below the resistance line. Some traders always use closing prices to chart a trend line. This method is especially easy to carry out using Japanese candlesticks. Here, all the candlestick bodies are situated above the support line.
But nevertheless, we strongly recommend taking the whole range of prices into account.
Let's plot a line in parallel to our main support line to give us a slightly hazy but precise enough boundary of price support. Soon we shall give you some numbers to calculate this hazy support.
It's possible to chart trend lines another way.
By identifying strong pivot points on the chart and using them to plot lines of support or resistance. The pivot point is a block of, say, 5 bars, where the middle bar is higher than its two neighbours on both the left and the right. In other words, it's a peak used for plotting resistance. Or vice versa, it's lower than its neighbours, and this trough is used to plot the support lines. We can be stricter still by requiring that the closing price of this middle bar is the highest or lowest close of all 5. In practice, we may have unwittingly used such points to chart our earlier trend lines, apart from observing the rule about the size of the closing price. Here are 2 more guidelines when evaluating the importance of a trend line. The more times prices touches and tests the trend line, the more valid that trend line is. So, a line that has been tested 8 times is more important than one which has been tested only 3 times. Secondly, a line which has held true for 8 months is much more important than an 8-week-old line.
With trend lines, by importance we mean reliability.
There is one more measurable characteristic of a trend. This is its width. To measure it on a bullish market, you have to find the peak which has risen the furthest from the support line. Draw a line through this peak parallel to the support line. This is the channel line.
These are the precise borders of our price channel on a bull market.
To map a similar channel on a bearish market, identify the appropriate minimum and draw a line through it parallel to the resistance line.
So these are the precise borders of the price channel on a downtrend. How can we make money with these lines?
When you are in an uptrend, what you do is buy near the support line. As price approaches the channel line, you fix your profit by selling. And when you go long, don't forget to set your stop loss a little bit below the support line. And how little is a little bit? Give it 10% or so of the channel width. Trust me on this one, it's a sensible risk. And even if W is around 300 to 350 points, our stop loss is no more than 35 to 40 points.
Now, the stop loss. Way back in the mists of time, when I was a young wet behind the ears trader, I can well remember my initial reaction to the term stop loss. Ha! What losses? I was young, strong and very, very clever. I was trading to win, period. But experience is an effective teacher, and I quickly learned here that the key word is stop.
The stop loss is Kerberos, a guard dog for your deposit. You know, it's sometimes more important for a trader not to lose rather than to earn, especially if you're managing someone else's money. To get back to the price channel, you should note that opening a short position near the channel line of an uptrend, no matter how profitable it may be in the future, requires other confirmation signals and, more importantly, more knowledge and experience than you have at present.
So learn technical analysis. What else can I say about the properties of trend lines? Well, nothing lasts forever, and trends must come to an end. How does the end happen? Price simply breaks through the trend line.
The breakout of a trend line is a very serious thing. It frequently means the reversal, or at least a pause in the course of the current trend. And it is of the utmost importance to endeavour to filter out false signals of trendline breakout.
There are no cut and dried answers here, and it's impossible to avoid a modicum of subjectivity.
The first thing you've got to do to verify a breakout is check where the closing price is. If on the day of breakout the price closed below the support line, it can signal the beginning of a reversal. But this is insufficient for most traders, and they wait for price to remain outside the price channel limits for 2 days in a row. This strategy is known as the 2-day rule. It's the original time filter.
Why do I usually talk in days? It's probably automatic. The fact is that all the rules of chart analysis were formulated many years ago when traders predominantly worked with daily charts. Many terms, including the 2-day rule, come from that time. Everything we cover for daily charts holds true for weekly and hourly charts, but I can't vouch for minute and 5-minute charts.
There are also price filters which can verify a breakout. Different markets need completely different filters.
But now I'd like to focus on the specific trading tactics for the currency market, and in particular your tactics in case of a breakout. This should clear up a lot of questions that you may have about the validity of the breakout.
When price rises and breaks through the resistance line, no one is 100% sure whether this is a true breakout or not. So what do? Well, we place an order to buy 5 to 10 points above the trend line, and we place this order when price is nowhere near resistance to be on the safe side, because we don't want to be left sitting on the fence. We've already calculated the channel width, and we place our stop loss at 10% of W below the resistance line. Here, that's about 15 to 20 points when we've taken spread into account. Now, we need to place our take profit order, but the question is where? The most likely price target after breakout is that of the channel width W. And for our reference, we chart a line parallel to resistance at distance W. We aim to close our position 10% of W below this line, which is sometimes referred to as the double channel line. This is where we place our sell order to close the position.
Well, that's our sweet trinity of orders placed, and now we're going to look at a few different possible scenarios.
Let's take the channel width as 60 to 80 points. This means that price could reach target in 2 to 3 hours, leaving us little time to verify whether the breakout is true or not. If the channel width is more like 150 to 250 points, that's a realistic size, then price could reach the target line within 2 to 3 days. Here, we should recall Murphy's description how resistance lines as well as levels transform into support lines and levels after breakout. Price tries to get back into the old channel, a process that we call testing the line. That is checking the strength of the former resistance line. We patiently move our stop loss and take profit orders parallel to the resistance line and the double channel line until the time comes that any one of them is executed. In this scenario, we have the time to think whether this breakout is true or not, to apply the 2-day rule or some other verification rule. What I mean to say is, we're only beginning to study technical analysis, aren't we? If after breakout price has moved more than 1/3 of W, then in all likelihood our boat will finally come in. Or, if in the first surge price breaks through the resistance level, the line can in turn become a new support level. It'll make our lives a lot easier because we can place our stop loss below it later, but only after price has reached a new maximum. This scenario favours us too. On daily charts, price channels can range between 400 to 600 points, and it can take up to 2 to 3 weeks for price to make its target, like on this Euro chart. However, the rules used to calculate price target and to set orders remain the same.
We'll move on to talk about some other methods of calculating price target in this, our section on correction.
We've just been covering breakouts on trend lines. Such breakouts frequently herald a change in the trend's direction. Only time will tell whether it will be for the short term or an intermediate period. Movements against the main trend's direction are known as corrections.
How far can a correction go? Is it really possible to calculate the probable price target? Yes, it is, but with varying degrees of success.
For simplicity's sake, let's take a bull trend. First off, we need to examine what's happening with the main trend. Find the lowest pivot point where it all began. We choose the candle with the lowest low in this pivot point. Now, where's the highest high of the highest pivot point? There you are. The difference H minus L is the price movement in the direction of the main trend. Now we plot a line from the highest high so that it's perpendicular to the horizontal line through the lowest low. We divide this vertical line into 3 and into 2. We are left with 3 points, a third, a half and 2/3 of H minus L. By projecting horizontal lines through these points, we have our correction levels. These values were put forward in the 19th century by Charles Dow. Half a century later, another well-known analyst, Ralph Elliott, proposed the more refined values of 0.382, 0.5 and 0.618 as correction levels. The majority of modern traders use these correction levels.
We call them Fibonacci levels. Why? You'll have to wait for our film on wave theory to find that one out.
Corrections cease very frequently at Fibonacci levels, and price goes on to move in the direction of the main trend.
When is a price movement a correction and when is it a reversal?
While we are still in the shadow of a preceding trend, it's a correction. As soon as we leave the shadow, saying goodbye to the old ways, we are in a fresh trend. On a bearish market, all the reasoning and calculations have a mirror-like symmetry. Let's flip the chart over and check. It's exactly the same.
Correction levels are a powerful tool in technical analysis. All you really need to know is how to use them correctly. Well, we shall study, we shall practice, and we shall learn.
We've covered many new concepts today. How to plot charts, what time scale to use. We've explored the nature of the bar and the candlestick. We've looked at trends and support and resistance levels and lines. We've considered the properties of trend lines. We've also talked about correction levels and pivot points.
Don't worry about these new words and techniques. We'll be revisiting these concepts throughout our forthcoming films, and we'll be applying these techniques again and again. Practice makes perfect, you know, and you'll find that through time you'll be able to plot and use these lines very quickly. But the skills and experience to trade confidently on the market will come later.